Hey, it's Michael. We're here for our fifth video talking about starting your business. And I would guess that in all of our discussions up to this point, you've all thought about starting a business from scratch. But it's important to remember that you can start any number of places. You can start from scratch where there's no existing infrastructure or employees or anything. You just have this idea and go. You can buy a franchise where you will have other people working with you in a similar way and giving you guidance and helping you get started. Or you can buy an existing business. Maybe a business someone else has started and they don't want to do it anymore, or they maybe don't have the management skills to make the business successful. And so there are all sorts of ways that you can start a business. If you're going to start from scratch, this offers you the most freedom, right? Because there's nothing predetermined. You can do literally anything you want. However, there are some significant drawbacks to starting from scratch. For example, you may find it hard to get advice and guidance from people who've done this before because they have no skin in the game. This is completely your idea with no boundaries. And so because there are so many opportunities and so many possibilities, and you're the only one with equity, it may be hard to get advice and direction on what to do next. It may also be very difficult to get support. What do you do if you're sick? What do you do if what you thought was going to happen doesn't happen? How do you get out of that particular rut? Or what do you do if you're into a bad contract? It's totally up to you to figure out how to get out of those issues. There's no support system, no backup to what you're doing. It may be hard to figure out structure in a business started from scratch. Because there are literally all the possibilities, you may feel overwhelmed. Gosh, do I go online or do I have a building? What product lines do I sell first? Do I sell services to go with my product lines? Should I be a service-only business? Because there are so many options, you may find it hard to narrow your choices down. It is much easier when you're only given, say, 3 choices, which one of these 3 do you like, to pick one, than it is when someone says, here are 3 million choices, which one do you want? You don't have to start from scratch. You can franchise a business. All those McDonald's that you see around the United States, those are all franchises. The McDonald's Corporation owns almost 0 restaurants. What they do is they sell basically a guidebook to someone who wants to own a McDonald's, and then the person who buys into that franchise must follow that guidebook. So the franchise is a business model where an owner, the franchisor, sells the rights to the logo, name, model to some sort of independent entrepreneur, the franchisee. So in the case of McDonald's, McDonald's is the franchisor, and they sell the ability to use the golden arches, the name McDonald's, the ability to sell Big Macs, et cetera, the coupons and nationwide deals that are going on. And then the franchisee actually runs the day-to-day business of each individual restaurant. And what you will likely find in the case of a McDonald's is that a franchisee will probably have multiple restaurants. So maybe they own all the McDonald's in Oshkosh or in a particular region. There are 2 common forms of a franchise. One is a product trade name franchise, where the franchisor owns the right to the name and trademark of the business, sells the right to use that name and trademark to a franchisee. But that's all it is. It's basically a brand is all you get. You don't really get a whole lot of other support. And this style of franchising focuses generally on supply chain management. In other words, you don't get a lot of help necessarily running your business. You just get the opportunity to buy raw materials and get them out to the marketplace. Or you can be involved in business format franchising, where the franchisor and the franchisee maintain an ongoing relationship. It's not just here, pay me some rights to use this name and this logo and some branding and you're on your own. It's more of a mentor-mentee relationship and more of a long-term partnership. The franchisor can offer help with things like, where do you put this business, site selection. They'll send you to training. I don't know if you know this, but there's such a thing as McDonald's University, where all franchisees go to learn how to run a McDonald's franchise. You can get product supply and market plannings, and sometimes they'll even be a limited partnership and provide you with some funding early on. I think what you will find is if you are looking for true growth opportunity and the best avenue to success, the business format franchise is going to be your better bet. Especially as a new business person, that level of support with training, supply, marketing demands, those you will find really valuable up front. Product and trade name franchising, these are things like Amway, where you get to use the Amway brand and you buy Amway products, but they don't tell you a whole lot more other than we'll just go sell a whole bunch of stuff. Those may be less expensive to get into, those may be easier to get into, but they also have a significantly higher failure rate. What do you get when you buy a franchise? Well, you get the name, right? I get to be McDonald's, I get to be Burger King, I get to be Culver's, I get to be Amway. You get a logo that everyone already knows. So all you have to do is put up your business with that logo on it, and people will instantly know what kind of business you are and what to expect when going there. You may get some products. For example, if you're a McDonald's franchise, you're selling Big Macs, you're selling Quarter Pounders, and not only are you selling those products, but you're getting them from the same supplier that everyone in your area is getting it from. And so it makes it really easy to have a product slate that you're putting out into the marketplace. You definitely get brand recognition, right? We all know what McDonald's is. We all know what Burger King is. We all know what Culver's is. There's no need to explain the rest of your business. When we first moved up here, we saw these Tom's Drive-In. If you're not from this area, you don't know what Tom's Drive-In is. Same way with down in Milwaukee. If you're from Milwaukee, you probably know instantly what Kopp's is. But if you're not from that area, you wouldn't. So getting a Kopp's franchise and setting it up in, say, Dubuque, Iowa, may not be helpful because no one in Dubuque, Iowa knows what Kopp's is. You may also get some promotions. There may be national or regional ad campaigns that the franchise puts on that all you have to do is then accept those coupons or accept those deals, and people will be able to leverage them and come to your business and use them. You may also get some marketing, right? The individual franchisees don't have to pay McDonald's for those national McDonald's ads. The individual franchisees don't have to pay Craig Culver to do those Culver's ads. That marketing comes with the franchise, and people know about your product and your business. However, when you are a franchise, you do give up some control. And it depends on the kind of franchise you're doing. For example, one of the things that McDonald's does is when you set up a McDonald's, you own the business, you own everything above the ground, but McDonald's actually owns the ground. You rent your land from McDonald's. McDonald's is one of the nation's largest landholders, one of the nation's largest landlords. And so you don't have much control, if any, over where your McDonald's is. McDonald's tells you where your McDonald's is going to be. You may not have control over your menu choice. McDonald's and Culver's and those places are going to tell you what you can and what you can't have on your menu. So you should do some research. You should do some due diligence and investigate before you sign that contract what you may have to give up. Here are some things you might want to investigate when you're doing that due diligence. Number one, all of these franchisees are going to have some sort of a uniform franchise offering circular. This is a form that gives you the details about what is going on in that franchise family. So legal status, financial status, personnel history of the people running the franchise. You definitely want to know who your partners are going to be when you join in this business, because a franchisor will be your partner. You're going to want to investigate any rules and regulations that franchise mandates that you follow. And every franchise is going to be different. So if you're going to enter into a franchise agreement with McDonald's, you want to make sure that part of that franchise agreement says someone else who already owns 9 McDonald's franchises can't set up another McDonald's right across the street from me. That you will be in a protected area, that you can use the name and the trademark, and how you can use the name and the trademark. Will you get any training? Will you get any management help, any forms, any tools that may help you run your business better? Will you be able to leverage national advertising, or are you supposed to run your own advertising? Maybe you want to leverage national advertising but also want to run your own advertising. Can you do that? Every single franchise agreement has lots and lots and lots of built-in rules and regulations. In fact, that agreement may look more like a book than a contract. So see if you can get your hands on that franchise agreement in advance, or at least a synopsis of it, and find out what you are going to be agreeing to, and find out how flexible that is. Are they willing to give you an exception for one or another thing in that agreement? And then once again, you're going to sign a contract. This is going to be a legally binding document that says this is what the franchisor must do for you, and this is what you must do for the franchisor. Now, be aware, this usually benefits the franchisor more than it does you, the franchisee. Why? They have the name, they have the brand, they have the logo, they have all the power in the relationship, so naturally they're going to write a contract that benefits them more than it does you. You will probably be required to meet certain sales quotas, buy certain equipment from the franchisor, buy your supplies and inventory from them, or if not from them, from their designated suppliers. So make sure that you understand all of those mandates before you sign something, because chances are they may not be the cheapest place for you to get stuff, but they're the brand recognition. One of the things that makes McDonald's McDonald's is that the customer knows whatever McDonald's they go into anywhere almost in the world. They know exactly what's going to be on the menu. They know exactly what it's going to taste like. They know what the environment's going to look like, right? The customer takes comfort from the familiarity of it. We all know McDonald's isn't the best food in the world, either in quality or taste, but we know what we're going to get. And that's what brings value to the McDonald's franchise. Thus, when you enter into a franchise agreement with McDonald's, all of that sameness, you have to use these kinds of machines, you have to get your beef from this place, you have to use Heinz ketchup, you have to use these kinds of pickles, you have to serve Coca-Cola. It's that consistency that is the key to their brand, and so they're going to lock you into that in those contracts. You can also buy an existing business, and this could be someone else's franchise that they've started. It could be a business that they've started from scratch. But the point is, this is a business that is already up and running, and the person who currently owns the business and is running the business is wanting out. Maybe they're wanting out because they're just old and it's time to retire, but they want to see their business continue on. Maybe you're buying a business from them because they weren't very good business people. But you see potential in that business still being a going concern. So you want to say, look, you leave the market, I'll keep your employees employed. Maybe I'll even pay off some of your debts that you've incurred. But I'll keep your location, I'll keep the brand and the capital and equity you built up there. When you're buying a business, chances are you're going to get some things already in place. You're probably going to get an established customer base, people who are used to coming to that business already to buy what they want to buy. Now, hopefully you're buying a business that's in good standing with those customers so that they want to come back. It is possible that your customer base are ticked off at the existing business and may not want to come back, and you may have to pull them back in. So it's important to understand the reputation of the business with the existing customer base. You're going to get some defined operating expenses. Maybe they've already got a building, so you already know what your rent is going to be. Maybe they've got some employees, so you already know what your payroll is going to be. The good news is you can know that in advance. The bad news is it's already established, and so if that's not the rent price you want to pay, you may be out of luck. If you think those employees are overpaid, you probably aren't going to be able to cut salaries very well. You're probably going to have to pay them what they're already paid. So there are some benefits and some drawbacks to these defined operating expenses. You're going to get fully trained employees. They've been working at the business. The bad news is maybe they're part of the reason the business isn't doing well, because they don't come in on time or they don't treat the customers well or whatever the case may be. So once again, be aware of the fact that your employees are fully trained may be a benefit, or it may be a liability, because maybe they're not trained in the way you want them to do things. Maybe they're not doing things the right way. And so you may have to retrain them or let them go and bring in other people. You're probably getting some facilities and equipment. You may be getting a building. You may be getting certain machinery. You may be getting some inventory, things that are ready to be sold. Once again, maybe that's a benefit. Maybe it's a drawback. Maybe the machines are super old and are breaking down, and that's why they went out of business, because they can't afford to replace them. Well, you're still going to need to replace them, but now it's your time. Maybe the building is dilapidated or in a bad neighborhood. Well, it's now your building. That's part of the business. So maybe you're going to sell and move, but then maybe that screws up your established customer base. But these are things that you may get as part of that purchase. You will definitely get a reputation. If that business was thought of as a good business, people will automatically assume that your business is going to be a good business, at least for a little bit. If that business was a bad business, you're going to have to start digging out of that hole on day one. Start changing that perception. And chances are, if you're buying a business, you're going to be buying some debt. So maybe the business is worth $50,000. You may have to buy it for $60,000 and pay off $10,000 in debt that the business accrued. Now, not all debt that you buy is bad debt. Maybe they just bought some new machinery and that's a good investment, and all you do is take over the payments on that loan. That's probably okay, provided they didn't overpay for the machinery, and the machinery is what you need in your business going forward. But chances are, unless it's someone who's run the business for years and is just retiring, perhaps that debt is there because they're bad business people, entered into some bad agreements, and now rather than declare bankruptcy and just close the doors, they found you as a buyer. You may have to assume some of that debt, pay those bad business deals off before you can move forward. So if you're looking at buying an existing business, if you decide I don't want to start from scratch and I don't want to be a franchisee, make sure you know the following things. Number one, are there any licenses and permits you need to operate your business? Let's say you're buying a restaurant and there's a bar in the restaurant. You have to have an alcohol permit to sell liquor in that restaurant. Will that liquor license transfer with the sale of the business, or do you have to reapply and get a separate liquor license? That's important to know, otherwise your bar has to shut down and or just serve soda. Are there any other building permits, any other regulations and licensing you need? You need to make sure you understand what is needed for that business to go forward. You need to understand any zoning agreements. For those of you who are unfamiliar, when a city has a property that has something on it, whether it's a house or a business, whatever the case may be, that piece of land sits in something we call a zone. The city blocks off certain parts of the city for businesses, certain parts of the city for manufacturing, certain parts of the city for housing. Sometimes it's a mixed use zone, so there will be some business and some housing in the same place. You need to know what zone your business is currently in, because it's possible that when the business started, it was in a zone that was designated for commercial business. But since that time, the city has rezoned, and now that land is either for residential or manufacturing use. Can your business be grandfathered in with the old zoning when they sell it to you? It's possible that once they sell the business to you, the new zoning takes over and you'll have to move. So keep those things in mind. You need to be aware of any environmental concerns. Maybe you're buying an old gas station, not because you want to have a gas station there, but you think the building looks cool and you want to convert it into a restaurant, or you want to convert it into a clothing store, or whatever the case may be. Well, those gasoline tanks in the ground are now your responsibility, even though it's not a gas station anymore. And if they start leaking into the groundwater, you could be facing some fairly substantial environmental pollution fines. So be aware of any environmental responsibilities you may have in buying that business. Even if all you wanted was the building and the land, you may be stuck with some of the legacy of the previous business. And understand what that business is worth. What is that fair price? And there's lots of ways that you can come up with the value of a business. We've listed some of them here. You can use one of these, you can use all of these, but you need to understand what that business is actually worth. So one way to do that is by calculating capitalized earnings. One way to do that is by looking at excess earnings. One way is by looking at cash flow. How does cash come in and cash go out? You can take a look at tangible assets or the balance sheet method. I have this building, I have these machinery, I have this land. Those are all tangible assets, and those have a value that you could figure out if you sold them on the open market. You can also take a look at some intangible assets. What is the reputation of the business? What is the reputation of the brand, if the business has a brand? Is there value in that? These are all things that you can take a look at and start measuring. And what I would encourage you to do, if you're thinking of buying a business, is look up how each of those methods of valuation work, and determine whether or not you want to apply one of these methods or another, because they will all give you a different answer to the value of that business. If I have a business that has fairly decent cash flow, but maybe is highly leveraged, meaning they have a lot of debt, or maybe they have old machinery, the cash flow method would give it a far higher value than, say, a capitalized earning method would, or a tangible asset method would. Because if I've got old machinery, it's not worth anything in the tangible assets. It's used up all its value, even though it may continue to work. However, I may still be seeing good cash flow. Once you've quantified your investment, once you've said, this business that I'm about to buy is worth $1 million, review your financial landscape, right? Now that I know what the thing I'm buying is worth, how much are you willing to spend? Maybe I can convince that person who has that $1 million business to sell it to me for $800,000. Maybe I have to pay $1.2 million for it because lots of other people want to buy that business and are also willing to pay $1 million for it. So review your financial landscape. What assets do you have at your disposal? If you spend that money in buying the business, will you have enough money, and will that business generate enough revenue to continue to operate, or do you need even more cash on top of it? The reason you have to do this is because ultimately it's not just about buying the business, it's about having the business be successful on day 2, month 2, year 2, decade 2. And so once you determine what kinds of businesses are going to be good for you, what your area of expertise is, how much cash you have on hand for initial investment, how much cash you're going to have on hand for ongoing investment, where maybe the business was running in the red, it wasn't making any money. Do you have enough cash on hand to keep it running for a few months, maybe a few years, until you can get it back to a profitable space? This will help you determine I want to look at buying this business. I don't want to look at buying that business. Consider what you do well and what kind of a lifestyle you like to live. Let's be honest. If you've got caviar tastes, you're not going to want to buy a business that is going to be running in debt for a long time. You're going to want a business that's going to be fairly successful, that's going to generate a lot of profit quickly. Maybe you're looking at franchisees. Maybe you're not looking at building from scratch or buying a business. If you're not willing to put in a lot of hard work, you're definitely not starting from scratch. You're probably not going into the restaurant business. All of those businesses require lots and lots and lots of hours up front from the owner before they start turning enough profit to step away from. If you don't have a lot of business experience, you're going to need a lot of hands-on help, a lot of advice. You probably want to look at a franchise. However, if this is the 9th business that you're starting, if this is you've been in an industry as the employee of a company for a number of years, and now you want to start a similar company, but you know how that industry works, you know how that business works, maybe you want to buy an existing business, or maybe you want to start from scratch. Understand what you do well, how you want to live your life, and that will help decide what kind of a business you want to start and run. And don't forget, these businesses don't exist in a vacuum. Understand the entire landscape. Don't just take a look at that business you're going to buy. What are the competitors out there? What is the economy currently doing? What is the current political situation? Understand everything that's going to come along in starting this business. Don't be afraid to look dumb, to think you're asking a dumb question. You need to know some of these answers. And if you don't know those things naturally, ask. Ask questions about contracts. Hire a lawyer. Ask questions about leases, about existing cash flow, about inventory. Because the more you understand about what you're getting into, the better decision you're going to make. I would hate for you to save up thousands of dollars and have someone come to you and say, hey, I have this business that I'm running. I'm wanting to get out. I will sell it to you for $10,000, and that's everything you have saved up. And what they didn't tell you is their business was being sued, and the business had some liabilities, and there were environmental concerns with the building, and the employees were striking, and all of these things, and now you've given them your $10,000 and they're leaving happy and you've got nothing. The more you know about what you're getting into, the better decision you're going to make. When you're starting, you will need professional help. You will need to hire tax advisors, especially when dealing with franchises. Tax issues are particularly complex. So, find a lawyer who understands franchise law. Find an accountant who understands how these franchisees do their accounting. You're not going to be able to do this on your own, even if you have an MBA, even if you've spent years in the industry. These are uniquely complex situations, and until you have direct experience, you're going to need help. I don't care how smart your grandfather, uncle, father, mother, grandmother, aunt are. You need someone who's done this before, who can help you make good decisions. You need to hire a lawyer. You need to hire a good accountant, because they're going to take a look at these documents that you're about to sign, that you will now be legally bound to meet the components of. And they're going to be able to say, ooh, this is a bad deal, or this is a good deal. And you need to make sure that these attorneys and accountants are also good and reputable. If you're going to buy a McDonald's franchise and McDonald's says, oh, you should go work with lawyer X, that might be the last lawyer I want to work with, because maybe they're not really working for me, they're working for McDonald's. Now, I'm not saying McDonald's would do that. I'm just saying, be aware, of you want people who are professionals on your side looking out for your interests. Because trust me, the people on the other side of the table, the people who are selling you their business or selling you that franchise, they're going to have lawyers and accountants looking out for their interests. You will need to review a letter of intent. Okay, this is the initial document that says, I intend to buy your business. Anytime you're going to buy a business, there is going to be some sort of letter of intent. Anytime you enter into a franchiseship, there's going to be some sort of letter of intent indicating that we're starting a business relationship. You're going to want to sign a confidentiality agreement, and they're going to want you to sign a confidentiality agreement. So if you're going to talk to McDonald's about entering into a franchise, McDonald's only wants to give out information about what it takes to become a McDonald's franchisee to someone who's highly likely to become a McDonald's franchisee. They don't want to give it out to the Burger King people. They don't want to give it out to the Culver's people or the Wendy's people. So they're going to make you sign a confidentiality agreement. Make sure you understand what that binds you to say and not say. Because you're going to need to get help if you're going to buy that franchise, or you're going to need to get professional help if you're going to buy that business. Make sure the confidentiality agreement doesn't preclude you from talking to other professionals. Have a lawyer and an accountant go over every single contract and lease that you're going to be forced to sign, whether it's a franchise agreement, whether it is a lease for land or a building. Make sure you understand what exactly is you're agreeing to. Have an accountant go over their financial statements. Some businesses are really good at hiding the fact that they're a crappy business. So make sure you understand where they make their money, how much cash they have on hand, how much debt they have. Are there any pending legal issues that may hit once that sale goes through? Make sure you understand everything about the finances of that business. Make sure you see their tax returns. If for no other reason, it will give you a rough idea of what you should be expecting to pay in taxes. But it may also point out some things that aren't always obvious in financial statements. If you lose money in a business, that can possibly give you a tax deduction somewhere else. And so maybe if someone owns 7 businesses and they're looking to sell you one of them, maybe that's their loss leader. And so they're keeping their tax bill down on all these other businesses because that's the one that's not doing well. And that's the one they want to sell you. So make sure you see their tax returns. And they're going to want to see your tax returns as well. Make sure you have a lawyer review your sales agreement, exactly what it is that you are required to sell, what it is that you are buying from them. Make sure you have a lawyer and an accountant evaluate a purchase price adjustment. If a business is valued at $1 million and they want to sell it to you for $800,000, well, why is that? Or it's valued at $1 million and they want to sell it to you for $1.2 million. Well, why is that? What could cause that purchase price to go up or down? Make sure that you're aware of any loopholes that may be to your disadvantage. Everything that we've just talked about is about being aware. Going into the situation with your eyes wide open, with enough knowledge that you can make smart decisions. Not all businesses are of the same quality. There are some businesses that are really good to get into, and other businesses that are basically legal robberies. You need to be aware of which kind of business you're about to get into. A lot of work from home businesses are just elaborate phone scams. We are constantly telling our college students, if you see something that sounds too good to be true, it probably is. There are flyers that you'll see all over this campus. It's like, earn $36,000 a year working from home, making phone calls 4 hours a day. No, you're not. Maybe one person did that, but that is definitely not the normal situation. So most of these work from home businesses are scams where you pay them a lot of money to have part of this business, and then When you try and earn money on your own from the business, there's no money to be had. They're making money because you're giving them money. Be wary of businesses that label themselves as direct selling or referral marketing or network marketing or multi-level marketing. Once again, they're making their money off of selling you the business, of selling you the product. And it may be really hard for then you to go around and sell the product. That's not to say that people can't make money doing that. What I'm saying is the vast majority of people who enter into those kinds of businesses fail. And these are the Amways, the Nutrisystems, the Tupperware of the world. Right? Brands we're all aware of, and brands that some people do well in. But it's hard to do, and you've got to be willing to put in a whole lot of work for it and have a little bit of luck, frankly. 99.7% of all owners of businesses that label themselves direct selling, referral marketing, etc., lose money and fail as a business. Almost 100%. But they're going to tell you about the 0.3% that are raking it in hand over fist. Are you willing to bet on yourself that you're that 0.3%? Or is it much more likely you're in the 99.7%? Once again, brands that label themselves like this: Amway, Avon, Herbalife, LuLaRoe, Mary Kay, New Ways, Nu Skin, OmniLife, Pampered Chef, Rodan and Fields. Once again, there are people who have successful Avon businesses. There are people who have successful Mary Kay businesses. But 99% of the people who buy one of these businesses don't make it. So that's the end of our discussion about entrepreneurship and setting up new businesses. You now have everything you need at your disposal to complete your project with your team about creating a business plan. When we get together next week, the videos are going to be more about, well, what happens now that the business is running. We're going to talk about project management, and we're going to talk about business ethics. So thanks for being here. Thanks for listening to the videos. Best of luck, and we'll see you in the next video.